Hi guys, welcome back to the channel. My name is Dave. Today I want to talk about a three-fund, easy to set up, simple portfolio that you can do on M1 Finance. This is the simple path to wealth. Easy, minimal headache, three funds, but over 12,000 different holdings. And I'm telling you, it's easy to automate with M1. It's got solid historical performance. So if that is what you're looking for, please stick around. Whoop. So I want to do this video because I want to show how simple it is to automate this part of your life and free up yourself for other areas. So a three-fund portfolio is a great way to get started. It's extremely simple to set up. It will save you time, and that time can be invested into real estate or your business or your job or whatever else it might be. Then you can put this aside. You don't have to worry about looking at every individual stock and trying to figure it out. So it's also powerful. It's had nice returns over the last 10, 15, 20, 30 years when back tested. But, obviously that does not guarantee future results, but it has a good historical return. So you combine that with the fact that we can use dollar cost averaging, which is extremely powerful, and it can be okay that in 2022, if you're like, well, what about a correction? Well, a 10 or 15 or 20% correction is going to be good for us because that means we're going to buy more shares as we buy consistently every week or every month. Put that money in, we buy at a lower share price. Well, that's great. That means when it does come roaring back in the future at some point, we're going to have an even better looking portfolio. And finally, I do want to show you how you can spice this up yourself. If you want to customize this a little bit within M1 or your own platform, you can do that, and you can look for certain sectors that you have a strong belief in and maybe try to even have a little bit of fun with it. Now, you can use any kind of brokerage account that you would like to, but I use M1 for this. It handles it particularly well. I do have an affiliate link down below. Isn't that convenient? But that's not the reason why. But if you use that and you deposit $100, they'll give you $50 in addition to that. That's a 50% return. Pretty darn outstanding way to get started. But I say M1 because I think it handles the dividends better. The pie idea is better. Rebalancing is extremely simple. And for me, it's my favorite utility that I've been using over the last year. I use Fidelity for options trading and E-Trade for options trading and handling all of my investments and trading accounts. I use this to throw money into and to grow my wealth, and it's extremely easy. So that's my justification for saying, yes, use that link, go out there and open up an M1 account because it does a tremendous job of doing what it's supposed to do. Now, the benefits of a three-fund portfolio like this is just how easy it is to manage just three funds, yet how diverse it is, because with two of these that hold stocks, you're going to have over 12,000 different holdings from all around the globe. Plus, with ETFs, you're going to have very low management fees. So the one we're basing this on today is off the Bogleheads three-fund portfolio, which was basically a cult following off of John Bogle, who founded Vanguard. Now, I'm not a Vanguard rep, but I do like a lot of their ETFs that I talk about on here. But in generic terms, this is a lazy portfolio. And if you go out and search, you'll find lots of information on different lazy portfolios too, so you can tweak this a little bit yourself if you like a certain set of ETFs. So what I decided to do was to start a little bit of an experiment here on M1. So I opened up a brand new account, and I'm calling it Simple Millions, and I plan to invest $1,000 to get things started, and then I'm going to add every week a little bit so I can dollar cost average throughout the year, and hopefully at the end of the year kind of give you a report card to see how this portfolio performed. But you can see this is kind of the generic Boglehead setup, and again, I'm not a Vanguard ref, but all these are all Vanguard. Now, feel free to substitute your own version of the ETFs that you would like as long as they cover these areas. But the normal breakdown is VTI, which is the Vanguard Total Stock Market ETF. Again, that gives you broad exposure to the whole US market. Then you got VXUS, which exposes you to the rest of the world, right? The Vanguard Total International Stock ETF. And the final item to round it out is bonds. I know not a lot of people are excited when they hear bonds these days, and I get it, completely do. But this is the Vanguard Total Bond Market ETF BND. The breakdown is 60-20-20. So this is typical setup for a young person that's starting investing. Maybe they've been investing for a while, but this is kind of the general breakdown. So great way to get started, but you can also get more aggressive. So let's take a quick look and see what we're getting with these three funds. So the first one is VTI, the Large Blend Equity ETF Vanguard Fund, the big boy here. Okay, and the top holdings are going to be stocks that you're very familiar with: Apple, Microsoft, Amazon, Google, etc., Facebook, Nvidia. And if you look at the return over the last 1, 3, 5, 10 years, it's been outstanding. 25.67% over the last 3 years, over 25%. Over the last 5 years, 18%. Now, that doesn't mean that that's what the future is going to hold. And that's one of the reasons we're going to balance it out with these other funds. That's what's so important. It also pays a little bit of a yield, so you're going to be getting something out of this every quarter. But if we go to VXUS, which is the Vanguard Total International Stock Index, you're going to see the returns here are not nearly as strong as they were with VTI. 9%, 13, 10% over the last 5 years. So not bad, but not nearly what the U.S. market has returned. But that's essentially why you want that balance. And if you look at what they hold, you're probably familiar with Nestle, right? Taiwan Semiconductor. But if you look at Tencent Holdings and you look at Alibaba, those have really underperformed the market. They got clobbered in 2021. That's one of the reasons that performance is down so much. But we don't know what's going to happen the next year. Those might be the big performers, and that's why we want to have exposure to the rest of the world. Now, the last component of this 3-fund portfolio that we've been talking about is the Vanguard Total Bond Market Index. And if we look at that one, yeah, it's not impressive. It's bonds, and it's U.S. bonds, U.S. Treasury notes. And that's where the vast majority of the exposure is. So you're not going to get a lot out of this one. But again, you want to have that bond exposure at least to a small amount. And probably as you get older, you're probably going to move more into bonds traditionally. So we're going to have that little bond component now. So I do believe that this setup offers some flexibility. But using this setup as of January of this year, 2022, the Bogleheads 3-fund portfolios returned about 11.4% over the last 10 years. But if you're somebody that wants to have a little bit more international stock exposure, you want to bump this up to 30%, take 10% away from the Vanguard Total Stock Market ETF, which focuses on the United States, bump that down to 50%. I think that's fine. If you want to reduce your bond exposure a little bit, again, because maybe you're a young person and you don't care about things like drawdown too much because you're going to buy into a volatile market, then you can reduce your bond exposure as well. But just understand those are the 3 components and you can adjust. But this is a great starting spot. No matter who you are, what age you are, this is a good place to begin, in my opinion. For me, and I'm not the youngest person in the world, but bonds are not my favorite to add to a portfolio right now, but they do help to reduce that drawdown amount when the market performs poorly, and it will perform poorly. Now, if you compare this to something like Ray Dalio's all-weather portfolio that has things like gold in a larger segment set up for bonds, well, you're going to realize that a lot of this is built out, so that when you have the highs and lows, they're not so bad. It's a pretty steady performer. So you're going to have highs and lows with this type of setup, but as long as we continue to dollar cost average into it, it should perform pretty well over time. Now, I will probably keep this down here probably around 10% for now until I get a little bit older, and I might give myself a little bit more exposure to international stocks for my particular experiment here. Now, other items to consider would be your age, of course, and how long you have until retirement, and also your risk profile. So for me, I'm willing to risk a little bit more because I don't have a time horizon until retirement yet. I plan on working for quite a while, so I think this setup is pretty good, and even shifting some out of bonds again into the higher stock holdings is going to be just perfectly fine for me. So for me, the stock market is a lot of fun, so discipline is sometimes required. And with this kind of portfolio, you want to consistently invest back into these 3, and you don't want to dabble with it or play with it too much. But that doesn't mean you can't branch out a little bit and add some spice to it. But trying to beat the market idea, I would probably steer away from that unless you really want to commit a lot of time to stock market investing. But if you want to add some other Vanguard funds like, might I suggest, VOO or VUG for growth, it'll add more growth exposure, or VOOG, another growth from Vanguard, or SPYD. I like that one a lot right now. I'm probably going to do a video on SPYD, Spider Dividend. So if you want to add more dividend and maybe take a little bit of money out of this and put it in your pocket at a later date, SPYD or VYM, that one also pays a nice little dividend. So there's lots of other options where you could start taking a little bit. You don't have to take too much, but you've got VTI at 60%. So if you took that back to 50%, and you put it at 5% into a couple of these other funds, that would be okay. But I would wait a little time. Get comfortable with it. Continue to invest into these and see how it grows, see how it performs if you like the return. So my plan for this experiment is to put $1,000 in right up front, and then every week $100. I'm going to automate that through my bank so it automatically does it. That's my discipline, right? So I'm going to throw that money in there. And I'll give you an update at the end of the year, and we're going to see how this portfolio performed over the last year. I'm sure there's going to be plenty of information out there, but I want to show you exactly how it worked for me and hopefully give you some confidence that you can be lazy like me and do all right in the stock market. So one nice resource that I found was a place called optimizedportfolio.com. So you could head over to optimizedportfolio.com/lazy portfolios to see what other lazy portfolios you might be able to create and invest using M1 or another brokerage account. But a great little resource. So I still run into a lot of people that don't have a lot of faith in our stock market. They're not willing to put a lot of money into it. But I think this is a good way to kind of automate some of your investing and slowly limp in using dollar cost averaging over time, and hopefully build up your faith a little bit that our stock market is a safe place to put some of your money and to help you grow your wealth and change your future. Now, if you have any questions on any of this, please ask down below. I'd be happy to help you. If you wouldn't mind, like and subscribe to the channel if you found any of this helpful. We'll see you next time. Have a great day. Whoop.